Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, October 10th, 2025. S&P 500 currently sitting at 6632. I'm David Zawing here with Ian McMillan. Plenty to cover this week, especially considering the price action today.
We should have started like an hour ago.
Yeah.
Been a lot of different vibes.
So a little bit of volatility, and I guess not really a surprise if you listened to last week's podcast. We highlighted quite a few flags out there, but to be fair, one day does not equal a trend.
It is not. Just got a few hours to go, 4 hours, so we'll see where this ends up.
Are you saying closing price matters most?
Yeah. We talked about kind of waning breath last week, talked about it in the client letter. Maybe not a huge, whatever comes of it. I mean, we're sitting here talking about like we're already in the midst of a 8% drawdown.
Right now, currently sitting down 1.5% for the S&P 500.
Back to where we were. I mean, yeah, we knocked out a couple weeks worth of move back to where we were on Friday, September 26th. Still in an uptrend.
Still in an uptrend. You know, last week we talked about divergent advanced decline lines, divergent percent of stocks above 50 and 200 days, the VIX rising with the S&P, same with triple C credit spreads, junk bonds versus intermediate bonds, no new highs. And so do we get to be surprised if this is the start? Markets are normally abnormal, so I don't want to say a normal correction, but some type of pullback. It's going to be really interesting to see how it plays out, or this is just a one-day deal. And was this your chance to get involved? If you haven't been involved, was this your chance? That's the psychological.
I'm jealous of people who have cash.
Our clients know we've been heavily invested for quite a bit, and it's been a good run. I mean, if we, using S&P again, if we look back to April, I mean, it has been a 35% approximately move since
we crossed above the 200-day.
So above the 200-day, about, if I include today, about 16%. Before today, about 18%. So pretty good move out of broad stocks, broadly speaking. And really this breadth deterioration that we talked about, you know, has to be repaired in one of two ways. Either broadly speaking, stocks correct or breadth expands.
We're not getting the breadth. Not yet. Probably doesn't look like it's going to happen today. And we've seen it across the board. I mean, I think it'd be one thing if maybe like the NASDAQ or the S&P or the Dow was kind of petering off. The New York Stock Exchange was holding in there. NYSE Composite is a better way to put that. But they all kind of rolling over. Over the last week. I mean, even as of yesterday or maybe it was Tuesday, when we were back up to, I mean, does NASDAQ hit an all-time high to yesterday, this morning? I think this morning it did, right? Now we're down 2%. So again, this is not like price has also been rolling over. You got to wait. This is the start of it. I don't know.
There's that divergent breadth underneath the surface. And then you're kind of looking at what are some areas that are deteriorating. And I know Kevin did some good work on financials this week. And you kind of look what's going on underneath the surface there. And there's some deterioration under financials. Now, on an absolute basis, still above a rising 200-day, still a sequence of higher highs and higher lows on a daily time frame, weekly time frame. But underneath the surface, there's some deterioration there. And then you throw in the downward resolution in junk bonds versus intermediate bonds today, breaking a rate of trend. And then you throw in XHB, home builders.
Yeah, terrible.
And what's interesting to kind of paint the picture there, home builders were divergent to the S&P back in 2022, right? So in 2022, the absolute low for home builders was June of 2022, made a higher low in October, and S&P made its 2022 low in October. So divergent. And now we have kind of this opposite scenario. S&P's at new highs, but XHB home builders did not exceed its December 24 highs on its move here into September. So you have divergent highs, and then you look at the relative chart of XHB and S&P, and then the work. Can you talk a bit? You share a really nice chart on PKB and XHB. Can you kind of touch base on that?
XHB, obviously home builders, PKB, more like the things that are used to make a home, and they've held up pretty well. It used to be very highly correlated. I mean, like 98% correlated outside of like 1 or 2 day blips here and there, 2 week blips. But yeah, over the past few weeks, big separation there. Over the past, probably 3 or 4 weeks where all those, and it's so interesting because maybe it's just more kind of proof of what we've talked about is the industrials do kind of hang in there underneath the surface. There's a lot of stuff working. XLI looks terrible. And I see when I go through the individual charts, a lot of these construction material names, I mean, they're hanging in there. But yeah, home builders, maybe they're the ones getting, I don't know. I don't know what the fundamental case is on that. You have to ask someone smarter, much smarter than me.
It is price and correlation are worth looking at, and the fact that there's some divergence here between XHB and PKB, home builders versus the things that home builders use to build, and the deterioration XHB overall. You throw in financials on top of that. There's some things here where you don't get to be surprised if there's a continued correction over the next month or so. At the same time, you don't get to say, broadly speaking, that that's confirmed. We're still talking about an S&P with higher highs, higher lows. You're still talking about IWM trying to hold all-time highs. It's close here. And you still have high beta versus low vol holding up, momentum versus the S&P still holding up well. And now we see, like we have the VIX up to 20 now, higher volatility, but volatility has been rising for 2 months. We've highlighted that in the past. Now we see, is it still 1 foot out the door? Is there going to be a put call spike, a bunch of put buying, hedging going on? That's what I'll be paying attention to, because it's typically when they stop shorting, when they stop hedging, thinking that these type of moves are not worth hedging against. That's when you run into problems. So do we get a put call spike out of today? We'll know after close. But it's definitely interesting to note. And again, 1 day doesn't make a trend. But if a intermediate term or like a shorter term correction were to take place, there's some signs here. The table is set for that. Wouldn't necessarily be surprising. But we can use tapes like this. We can use red tape to our advantage and look for things that are holding up well. Is there anything that sticks out to you that's holding up well?
Well, I guess given the news of all this, today in a silo, uranium's been strong. Gold, I guess anytime. I don't know if you can use today as an excuse for why gold's up. Gold's been
up for a while.
Just parabolic. Gold miners even more. Junior gold miners even more. I mean, we can keep going down the beta train. We can go all the way to junior copper miners. Silver, yeah. So I palladium, all that. Treasuries, Russia treasuries is that risk off thing. Treasuries have kind of been basing out here for like 2 years. So, and then, you can see it in the long-term treasury yields chart, which is just TLT. Yeah, it'll be really interesting to see. That was another talk. I feel like we always discuss interest rates in the client letter. So we'll see. We'll see if our higher for longer thesis gets tested, which I'm open to that. Said as much in the, I can't believe what I said, maybe below like 4%. 4%. Yeah. Interest rate, if the 30-year treasury yield got below 4%. Maybe we're rolling over. Right now, let's get below 4.5. Obviously, yeah, those are working. Is it all coming together? Staples have hung in there, but staples have been terrible. And I don't just mean on a relative basis. You say, oh, Ian, well, yeah, market's been ripping. Of course, staples have been terrible. No, on an absolute basis, these things.
Barely positive on the year.
Can you believe that? I mean, yeah, you wouldn't expect them to be up with the S&P, but, it's typically just a lower beta uptrend that, pretty much tracks with the market. And I don't look at staples enough to know, right? Because Walmart's hung in there. Johnson & Johnson is a staple. Or is that considered healthcare?
But your point is made. I mean, that they haven't.
Costco.
Mm-hmm. Costco used to be a leader. Kind of has fallen off a little bit.
Coca-Cola. I do remember does Kevin have staples? I think he mentioned Coca-Cola.
So there's some things here. I mean, and if we've got, I can't tell you how many times being in this industry for going on 25 years now, how many times I've seen corrective behavior in October, and most want to go directly to like 2007, 2000 when, things really fall apart. But there's also plenty of times where there's a correction in October, and the old saying, buy in October, get yourself sober, that it's a buyable correction. And that'll be interesting to watch, that those who haven't been participating aggressively, will they start to, if there's ongoing corrective behavior in October? Time will tell. We don't really operate with the information we have on hand. We don't know the future. We don't have future prices. Go ahead. What were you going to?
I do wonder, right? We talked a little bit last week about, and it's come if you go into social media, it comes in the form of complaining. Dave and I would just tell you, it's just a market that doesn't let anyone in, right? Every 1.5% intraday correction has been scooped up. I would say not, the 200-day, but I would say, probably since we got to all-time highs, like around 6,100, 6,150. Now, I guess early August, there was like a little 2-day blip. But all this is just, we barely spent any time below a 20-day moving average. In the last 5 months, we have spent a total of four candles below a 20-day moving average. So on the back, I promise I'm making a point here. Is this just end up being something where if you're under allocated, if you're behind for the year, it's a grand opportunity to get some of that back?
That's the emotional purgatory that asset allocators could be in, is if they haven't been participating that greatly in this, is this an opportunity to do so?
Or is this the top, Dave? Is this the top? The top.
I wish we knew, Ian. As you know, we're going to be 0% exposed at a bottom and 100% exposed at a top. You never know it's a top until afterwards. You never know it's a bottom until afterwards. And so time will tell whether this is a top, whether we've got a top in the S&P or stocks overall. I will say it's, the fact that there's been breadth deterioration underneath the surface, this could actually provide a great opportunity to reset breadth. Because we're not talking about like the bullish percent sitting in the 80s or 90s going into this.
That's a good point. Yeah. What were we at? 58?
Yeah, like 58. So we're sitting at midfield. This isn't, this could be an opportunity, because typically what in past major corrections, like your 08, 09, I'd even say, the 21, 22 period, you typically see bullish percent up in the 80s. Market gets really narrow at that point, and your previous high flyers really sell off. If you look at your previous high flyers like ARC, right? Really going into the first part of 2021, really high bullish percent readings, your high flyers like ARC, all of a sudden they sell off once bullish percent flips to O's, but we're not in the 80s or 90s in bullish percent.
To your point, 21, we peaked out at around like 78.
And we're not there. I'm not saying we have to get there. I'm not saying we can't have a correction with a bullish percent at 58. That's not my point. It's just there's been plenty of deterioration over the last few months that if we get the majors, the large cap names to correct down, that it could turn, somewhere here in October. Isn't it classic, would set up the strongest 6 months out of a 12-month period, the November to April period, to be so classic to see some short-term correction that resets the table for another leg higher, right? That gets everybody, all the shorts buzzing, people wanting to get short this market, right? It's gone too far, too fast. They're going to load up on shorts. And that's really why we need to be watching that, is watch the put call ratio to see, are they still going to short this? And if they do, most likely this is going to turn into another buying opportunity. If they don't, I'll sit up and take notice for sure. And especially if we're breaking below important levels like a 200-day moving average or previous interactions between supply and demand that are important, you have to wait for the information to come in. Right now, the uptrend remains intact. Yes, we have some of these divergences out here, but is this broad corrective behavior led by large caps going to turn into an opportunity? I've seen it too many times in the last 25 years where October turns into being a great buying opportunity. We'll see.
I agree.
What else are you noticing out there? It could be, we talked a little bit about treasuries. It could be anything in fixed income. It could be crypto.
What do you think about biotech?
Biotech?
Makes me want to throw up. Can't believe we're talking about biotech on our podcast.
I think it's very interesting that a risk-on area, you don't go hide out in biotech stocks if the market is going to tank. And the biotech strength is noticeable in this tape.
It is definitely, that's by far the sector that will produce the craziest charts. I mean, when those things get going, this morning going through stocks, right? So market's been down a little bit. So looking at stocks that are moving higher, and I mean, a good chunk of it, it's just ABC, pharmaceuticals, XYZ, therapeutics, just all the way down. Varying degrees of liquidity, we'll put it that way. Play carefully. But, yeah, I mean, and you can see it. Kevin brought it up this week. I mean, biotech it's there. You see it in the ETFs as well. And speaking of healthcare, you're positive on the LLY, right?
Positive on the L.
You like Eli Lilly?
Oh, yeah.
Eli Lilly?
Yeah, Eli Lilly.
Isn't that, yeah.
Yeah.
So,
it's interesting to see how that kind of turned into, previous market leader. Of course, it gets the very top of the Lilly chart is a cover from The Economist on the everything drugs. And we've been in a correction since then, which was August of 24. But now you have a false breakdown in their hands in Eli Lilly. And does Eli Lilly return to leadership for healthcare and the market overall? For right now, it appears that way. We'll see.
You heard it here first. Dave's giving out financial advice.
Absolutely not.
Absolutely
not.
No, it's a super interesting chart. So yeah, if you think that healthcare is going to get a relief rally, or maybe it's just a new bull market in healthcare. I don't know. What are those stocks that have held up well?
Yeah, and I
got to put that in the bucket. Yeah,
I think it's interesting. Gold miners holding up well in this tape. You mentioned biotech. Those aren't really, I get the whole gold is risk off. I get that. But gold miners doesn't necessarily have to be. It's when gold miners are outperforming gold itself, tends to be risk on for the.
Yeah, what do you think about gold's interesting? Have you gotten texts on gold yet? I've gotten 2 texts on gold in the last 24 hours.
No texts on gold, but I know there was a client meeting where the client wanted to hold physical gold bars.
Great. I can point you in the way of a pawn shop.
But if we're seeing high beta stocks hold up, if we're seeing biotech, if we're seeing, uranium, things like, I don't know, aerospace and defense, or more specifically aerospace, still hold up.
Yeah, aerospace, those continue to, your Rocket Labs and all that stuff, hanging in there. You mentioned crypto earlier.
Yeah.
Anything cool? Anything cool happening?
Be nice to see BTC or Bitcoin firm up here and not be a false breakout above 123,000.
Yeah,
but we'll see. I mean, Ripple's interesting because it's been consolidating in this compression, and holding $2.77 or 75 cents for a while. The first low there was in August. Now we're another one in September, and here we are in October testing that level again. That will be interesting. I could see a scenario where there's a false breakdown, shake people out, and it moves much higher.
I could see that.
But so far, pretty decent consolidation. And there's other things in crypto. We've talked about Tron on here before. So we'll see. Ethereum, really nice consolidation, but it's gotten sold pretty hard here near levels near the highs from November of 21. Do we still hold this? Market's good at shaking hands out before it moves higher. If these are truly uptrends, then eventually these consolidations will break to the upside.
That's true. I've had my hand shaken.
Happens, right? You got to obey your stop losses.
When you're like a little kid and you meet one of your grandpa's friends, he's got a super firm handshake, and you're like, ah.
Oh yeah, we all know that. We all know that guy. You got to be.
That guy's seen some stuff.
Yeah,
I'll be honest
I believe
with you.
that.
That guy has seen some stuff.
I'm a fan of the in between, right? Firm can't be fishy, can't be one of those like just hand you a limp hand.
No.
Immediately the conversation might be over. I don't, when you do that, the limp hand thing, not a fan.
If you have a limp hand, I'm not even going to move forward with the do you watch football question. We'll just skip over all of that stuff.
But also, if it's man to man, I don't know if I'm down with the whole like trying to crush your soul with a handshake.
Oh no, yeah, you can't crush it.
Now,
can't crush it. I mean, who are you trying to one up here,
if it's my
buddy?
son and if it's my son, my 14-year-old son, and I'm trying to teach him how to be a man, yeah, I might be a little more firm than normal just to let him know Dad's here. Dad's in the building. You gotta up your man game, right? You're 14. You're a man in training, MIT. But yeah, don't be the limp hand guy. I think I'd rate that worse than the soul crusher handshake.
Oh yeah, I mean neither are ideal. If you're over the age of 70, I think you can. I think you can get away. I think maybe those men feel like they're older and weaker, so then they're like, oh, I just need to squeeze a little harder because I don't squeeze as hard as I used to, but they actually do. So then it's like they overcompensate. Yeah,
or maybe it's like same relationship that I have with my kid. If a 60 or 70-year-old does it to me, maybe they view me like, hey, you're still in training.
Yeah, wow. Can you imagine that? Maybe we should ask. Hey, Billy, why'd you do that?
Everything okay?
And then what if you said, because you're still a man in training?
I could see that. I'm still growing up. My wife knows this.
Yeah.
It's good. Not to get us off the handshakes. It's interesting to note where we're seeing semiconductors potentially pause. I mean, they did make new all-time highs on a relative basis, so I can't be here complaining.
Yeah.
But we do have, to summarize, some deterioration in financials, deterioration in home builders, deterioration in, when I look at J&K versus IEF, a little bit problematic. Be interesting to see where the numbers come in for CCC credit spreads at the close. We've got a VIX spike finally here. Is this a one-day deal? Is this a couple-week deal? Or is this the top? We won't know till later. But you can't say there weren't signs. We've highlighted them on past episodes. But could turn into a tremendous opportunity to participate if you've been under allocated.
And what if they revise payrolls down?
Well, we don't get any more government reports, right? Like
oh yeah, no more government reports, and we're only doing earnings twice a year.
So government shutdown. I'm sure that's got. No, I think to me, all the narratives out there on government shutdown, I get it. To me, the two things that maybe bother me the most with that is military personnel not getting paid or on furlough, and national parks being closed. So those two, I'm kind of like, I feel like those.
Yeah, my wife and I were talking about the national parks thing the other night.
I feel like you should pay the people who defend our country. Like, just because politicians can't get their crap together, like maybe make sure military personnel are paid. And I know I'm talking in broad strokes. I'm sure there's certain contingencies where certain groups are getting paid, but don't like that very much. But I will say I've survived. The sun has risen every single day since the government has been shut down.
It has. Stock's done pretty good throughout. I mean, government shutdowns. It's just such a nothing burger now.
Yeah, we highlighted last time that,
other than the pay, I'm not trying to make light. Yes, you make a good point. I'm not trying to make light of. But as far as the market's reaction, God, I remember the first few. Oh my gosh, a government shutdown. What could this mean for the global economy? Apparently nothing.
What about international stocks, Ian? You bring up a good point there. What are we seeing out of international?
Well, I mean, really not that amazing.
You look at VEU, so total world minus U.S. stocks versus U.S. stocks, still on a downtrend.
Yep.
But there's pockets. We talked Peru last week, I believe.
EFA has been weak. I mean, you still want to be in emerging. Well, we'll see. Emerging markets versus developed was looking pretty strong, but I don't know. After today's scandal, it's a little. China hasn't really done it yet. China also down 4% today.
A little bit of news.
Oh, yeah, that's right. We did get news. I always forget that.
Yeah, we will see.
We'll see.
And I know that's not a fun thing to say. Like some people might be listening and want a prediction. It's just not possible. I'm sorry. We're not in the prediction business. We're in having a plan business. And having a plan means, looking at important levels from the past, whether it's September 25th and the S&P's 6608, or even earlier this year, the 6,300 level. These are areas that we would be keeping an eye on. You mentioned the 20-day moving average. There's a 50-day moving average at 65.30. Plenty of places that we can look for clues on who has continued control of this market. And it's a little early to say sellers have control of this market. Got a point of control at 6,400 since the April lows in S&P futures. Some areas here that we can observe price behavior, the interaction of supply and demand, and make some risk on, risk off decision making. So it's not without a plan. I couldn't tell you where the market ends this year. I wish I could. I wish I could give you a prediction, but that's not really our process. Better to have a process than a prediction.
That's not going to get you in the Wall Street Journal.
Not very sexy, right? But it seems to work. Having a process seems to work.
So far.
All right, Ian, anything else you want to highlight for our listeners? I do want to make sure I bring up the supporter of this podcast, the Adaptive Select ETF listed on the New York Stock Exchange under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principals. ADPV is distributed by Quasar Distributors, LLC. And maybe we could talk a little bit about that. It's interesting to note the things that are in and not in the Adaptive Select strategy. We talk about things that are up in a red tape, and I think it's interesting that MP is up in this tape.
Yeah, could be newsy.
Yeah, MP materials, but also how the strategy seemed to shift away from tech and more materials a while ago. So it's just interesting to see what the strategy does, what it latches onto. That sometimes is very informative. Anything else you want to highlight for our listeners?
I don't have anything. I think not a great. Oh my God, I sound like we're down 5%. It's just wait and see. I mean, breadth is stalled out. Can't be shocked if we get a correction here, but we're still in a very, very, very strong.
Yeah, we'll know later on. If we record price near lows today, we'll have some bearish engulfing candles. Those don't matter on a weekly time frame. Those don't matter until you have follow through. If you get follow through, then we're looking for where does demand step in, and so we'll see. Whether this is a 1-day deal, couple week deal, or something more. And unfortunately, we can't tell you what it's going to be until we get more price. More price, Ian. We need more price.
We have to wait till Monday, I guess.
Well, we thank everybody for listening. We hope you enjoy these episodes and find them informative and insightful. Please share them with your friends and family. Give us a high ranking of choice on your platform. We really appreciate it.
Have a great weekend, everyone.